The big switch is on in the mortgage market. In just the past 6 months, the amount of interest-only (IO) loans held by the banks have dropped by around $36 billion, according to the Australian Prudential Regulation Authority. APRA can feel pretty chuffed with the result. It is exactly what it wanted in its push to de-risk banks' balance sheet by quelling the speculative bravado of investors. But there are obvious side effects in targeting interest-only loans. They are the instrument of choice for not only investors biding their time in the tax haven provided by negative gearing to make a windfall gain on capital appreciation. They are also used by maxed-out borrowers repaying as little as possible, hoping for a bit of financial headroom if wages pick up. Unfortunately, wages show no sign of picking up. As the 19th-century Prussian Field Marshal Helmuth Graf von Moltke once noted, no battle plan survives first contact with the enemy, and APRA's insurgency has the IO brigade scampering in retreat. It is a retreat that will further cripple the spending power of cash-strapped households and has profound implications for the Australian economy, according to the big Swiss investment bank, UBS. Already household wealth built up by years of rising house prices shows signs of peaking as the market cools. At the same time, savings are being eroded just to pay for the essentials, such as utility bills and mortgages, leaving many households at a financial breaking point. So far, the switch from IO to principal and interest, P&I, has been small, but momentum is building. We estimate that the additional household cash flow hit from switching to P&I was only around $1 to $2 billion, or just 0.1–0.2% of total household sector income, UBS chief economist George Tharrow said. However, Mr. Tharrow said there is likely to be a notable and increasingly negative impact over time. For those with little or no headroom at the moment, a 50% jump in repayments may simply be impossible to finance. On figures put together the UBS banking analysts, the potential expiry of IO loans in coming years will surge up to more than $100 billion in the 2018 financial year. Assuming the typical 5-year maturity and no rollover to another IO term, almost $140 billion of IO loans will have wound up by 2019. A figure which jumps to $153 billion in 2020. A survey by UBS of borrowers found that the majority under financial stress from higher interest rates would cut consumption, while a significant share would sell their property. But that might be just the start, as Phase 3 of APRA's macroprudential tightening may well start next year. Phase 1 put a speed limit on the Big Four banks' investment lending, capping growth at below 10% a year. Earlier this year, Phase 2 was enforced, limiting IO loans to 30% of new residential mortgage loans. Before that tightening, IO loans accounted for up to 40% of the bank's mortgage portfolios, which APRA noted at the time was quite high by international and historical standards. Phase 3 is expected to zero in on the net income surplus, NIS, or a lender's assessment of surplus income borrowers have left over after living expenses, debt repayments, as well as some pocket money, as well as loan-to-income valuations.